Hello everyone, I'm Marcus Warren and I want to thank you for taking some time out of your day for today's webinar. We're going to be discussing Biden's proposed tax plan and how it might impact your financial planning. And so this is one of a series of webinars that we'll be doing this year. So if you like this topic or you like financial advice topics in general, then you'll get a notification when we release a new one. Most of you who are watching this now have received some information from us in the past, so the good news is that I don't have to talk about myself, and I won't. However, I do want to begin with a warning, because any time that I talk about tax or tax policy, it can be perceived as a discussion about politics, and nothing's more divisive these days than discussing politics. So this is not a political discussion. This is just the way things are. And so I'm going to be presenting it to you in that light. So whether you think that the proposed tax changes are good or bad, that's your decision. I'm just trying to basically lay out what could possibly happen. Because let's face it, really, as it is right now, we're still in the negotiation stage. And if you know how laws get passed, particularly through the Senate, nothing may happen. But we have to be prepared. And so I'm going to show you why I believe, regardless of the future of the government makeup, that there has to be some changes. So with that being said, I want to begin by encouraging you to operate right now in a distraction-free zone. So if you can close the door, exit out of any other apps you might have on your computer, turn your cell phone off or turn it down, this is going to be an opportunity for you to learn stuff. And if you can limit those distractions, I think it's going to be helpful for you. Also, I want to emphasize that I am not giving financial advice. This is purely educational. You'll need to discuss anything that I talk about with your own advisor. However, if you do want to discuss it with us in that respect, then we can schedule a phone call. But for the sake of this 30 minutes or so, I'm going to be speaking. Just please understand that I'm giving you information that you can use. I'm basically not telling you what to do. All right, so there are three primary things that I'm going to cover with you today. Number one is going to be the review of the possible tax code changes over the next 6 months or so. Two, we're going to talk about the steps that you can take now to prepare yourself. And then lastly, we'll talk about things that you should be doing moving forward. So who is this webinar for? Number one, this webinar is for people who have money in a 401k, 403b, or an IRA. Basically what we call tax-deferred accounts or tax-deferred buckets. If you do have money in a 401k, IRA, or any kind of company retirement plan, then pay close attention to this presentation because the proposed tax changes will impact you. Remember, you have never paid taxes on those funds, and the taxes that you will have to pay depend on whatever the tax law is when you begin to take money out of those accounts. So, I'm going to begin by talking a little bit about the current tax code. Now, I don't want to bore you with a lot of tax stuff. I just want to give you some highlights. So, as you may be aware, the top individual tax rate is currently 37%. Now, the Biden administration is proposing raising that. And I'll go over those tax changes in a second. Now, the top business tax rate is 21%. And the top capital gains tax rate, which is the tax that you pay when you sell something for a profit, is 20%. And this is the rate that you pay when you've held an asset for a year or longer. It could be a stock, it could be real estate, it could be a collectible. And the last tax, the one that doesn't really get talked about a lot, it used to be talked about all the time, but that's the estate tax. So right now with the estate tax, if you die with an estate that's worth under $11.7 million, which is obviously most people, you don't have to worry about federal estate taxes. And if you're married, you should be able to shelter about $23 million in federal estate taxes. But this is the one that I think is going to change because it really wasn't all that long ago when that number was $1 million. Which meant that a significant amount of people were paying federal estate taxes. So in order to generate more revenue, I think that's an easy one for the Biden administration to possibly change. All right, so what are some of the changes that the administration has floated out there? So the first thing that they've talked about is basically raising that corporate tax rate from 21% to 28%. Now, unless you own a corporation, this may have no effect at you at all, although it could potentially affect things like the cost of goods and services, assuming that corporations pass those costs and fees basically down to us, which, by the way, they generally do. If you have an S corporation, there's talk about changing the tax treatment there, so that you would have to basically pay more tax on your payroll earnings. Now, there is also a proposal to implement higher capital gains tax rates. Like I said earlier, the top capital gains tax rate is 20%, and they're proposing moving that higher. Now, what I'm most concerned about, and what you should be concerned about too, is the proposal to increase income tax rates. The proposal on the table is to raise the top individual tax rate from 37% to 39.6%. Now, you're going to need a little history here. So we've had marginal income tax rates in this country as high as 94%, and that was in the 1940s. In the 1970s, the top tax rate was 70%. In the 80s, the top tax rate was 50%, and through the 90s and 2000s, it was 39.6%. And today, the top tax rate, like I said, is 37%. So as we look at this, we can see that right now, the tax rates are the lowest that they've been in a generation. So those are some of the proposed changes that are out there. Now, my concern is this. These proposed tax increases are going to be higher than what's currently on the table now. Because here's the reality. The federal government deficit, it was $3.1 trillion in 2020, and that's more than triple from 2019. And this year's deficit is around 15.2% of GDP, and that's the highest since 1945. That's the reality. But not only that, but if you go to debtclock.org, you can see that the current national debt is over $28 trillion. And this has to be paid, and that interest on that, it has to be serviced. Now, if that were the only thing we were facing, I think that we probably could handle that problem. But it's more than that. And this is why I don't think that it matters who's in office. 10,000 baby boomers are turning 65 every single year, and they will begin taking Social Security and Medicare benefits. That means the government will need more money for entitlement spending. Now, entitlement is not a bad word here. And sometimes when I say entitled, people say, what do you mean by that? I paid for that. And I'm like, yeah, I know, you paid for it. Therefore, you're entitled to it. It's actually a good word. Anyway, you see, Social Security, Medicare, and even Medicaid, they are grossly underfunded. And if there aren't major changes, we're going to have some serious issues in the form of higher taxes to pay for those programs. Now, if you don't believe that tax rates have any chance of rising in the future, then you can pretty much ignore everything else I'm going to tell you. But if you believe, like I do, simply because of math, not politics, math, that tax rates have to go up in order to fund a growing national debt, the cost of Social Security, Medicare, Medicaid, not to mention other things that politicians like to propose, like free college or forgiveness of student debt, I think that taxes are going to have to go up. And I really don't think that it matters who's in charge when that happens. Now, there are other changes that have been floated out there, such as a tax on assets. You see, right now, we only tax income, other than property tax. But no one's going after your 401k and saying, hey, you've got a little too much money in that 401k account. I think we need to tax 1% of it every single year. However, it has been proposed. This one has also been proposed, a lower tax cut on the 401k contributions. So instead of writing off the whole amount, you're going to potentially receive a tax credit that's going to result in a smaller write-off amount. And so here's another change that concerns me, and that's a change in the required minimum distributions, or RMD. So just a few years ago, we had a change. You didn't have to start pulling money out of your IRAs or 401ks or qualified plans until you were 70 and a half. Now it's 72, and you have to pull out roughly 4%. So what I think that you're likely to see is an increase in how much money that you'll have to pull out at 72. Now that would be a very easy way for them to raise taxes without actually raising taxes. They just basically say, well, you just have to pull more money out. Another possible tax increase would be to make 100% of your Social Security benefits taxable. So right now, depending on your income bracket, you could be paying tax on up to 50% of your Social Security benefits or 85% of your benefits. Now, that doesn't mean you're paying 85%, an 85% tax rate. It just means that the vast majority of your benefit is subjected to taxation. And the problem here is that it's the earnings that you have in entirety that determines whether or not you pay tax on your Social Security benefits. So if you're pulling money out of, say, an IRA, or you're receiving a pension, that money calculated with, by the way, half of your Social Security benefits will determine whether or not you pay tax on it. Well, they can change that. They can say, basically, you know what, everybody has to pay tax on it. They could say, well, it's no longer 85% for certain earners, it's 100%. And here's another one that I think is probably coming. Right now, if you're working, you're only paying Social Security tax on roughly about $120,000 of whatever you earn. And if you earn more than that, then you're not paying that Social Security tax on any amount you pay, any amounts that you make above that threshold. Well, that would be an easy one for the government to change. Either they can raise the threshold to say $200,000, or just say whatever you make, you're going to pay the Social Security tax. And when you add that to Medicare and Medicaid, that's 7.65% that you pay. And by the way, it's not deductible on your tax return. And if you're self-employed, fantastic news, you get to pay it twice. So these are the possible changes that you've kind of heard being floated out there. What can you do about it? Well, there are 4 options that I'll briefly describe, and those are the Roth IRA conversion strategy, the use of an AB trust to shelter assets from estate taxation. Third one is whether or not to consider paying tax now on taxable or tax-deferred accounts. And then last, utilizing life insurance to offset tax on your assets. All right, so let's talk about the Roth conversion strategy. Now, you might be familiar with this. If you have a traditional IRA, then you've never paid tax on any of the money that you have in it. When you do pull that money out is when you pay the tax. Now, one of the things that you can do is you can convert that traditional IRA to a Roth IRA. And when you do that, you do have to pay the tax on the money that you've converted. Now, the key point here is that you don't have to convert it all at once. You can convert part of it. So if you're looking at your current tax bracket and you notice that, hey, I could make another $50,000 and still stay within your current tax bracket, then you could just convert that $50,000 if you want to. So what's the advantage to that? Well, the advantage is this. If that converted money grows in the future, you don't pay any tax on the growth. It will be completely tax-free to you, and it'll be completely tax-free to your heirs. So if you're concerned that the tax environment we live in today is the lowest that it could ever be, then this would give you the opportunity to pay the tax on some of that money now versus later. I think it's worth contemplating. All right, so let's talk about the AB trust. Remember, I said earlier that you could shelter about $11.7 million free from federal estate taxes. And if you're married, you could actually do it twice, and that would be like 23.4 if I'm doing the math right. So how do you do that? Now, I don't want to play lawyer here, but through the use of having a trust for both you and your spouse, a living trust that ultimately becomes an irrevocable trust at your death, you'll be able to take advantage of those tax credits. If you don't do this and one spouse predeceases the other, which always happens, you're only going to be able to use one of the 2 exemptions. But $11.7 million is still a lot of money. But what happens if they change the estate tax exemption to what it was not too long ago, to just $1 million? What happens then? Well, it could mean the difference between your estate paying federal estate tax or not. All right, so the third strategy is to pay the tax now versus the tax rate later. For example, if you've got this stock or land or real estate investment with a low cost basis, maybe you can sell it now and pay the 20% capital gains rate instead of a potentially higher tax rate in the future. You see, whenever it comes to making a significant sale, you should always consider the tax implications. Why? Well, it goes back to the old adage. It's not what you make, but it's what you keep. Okay, and last, number 4, I mentioned life insurance. Now, normally, I don't recommend people consider life insurance when it comes to retirement. In most cases, there's no need for it unless you want to use it as a gift to your heirs. Now, in some cases, life insurance might be able to provide you with tax-free income. The cash value of a policy that you may have, it may be accessible to you tax-free. So maybe you put in $100,000 in premiums and it's grown to $200,000. With some life insurance, there is a way that you could access most of that money and not pay tax through loans and withdrawals, provided that the policy was funded properly. But that's not the main point. The main point is the fact that the death benefit is paid to your beneficiaries with no income tax owed. So if you do foresee yourself having an estate tax problem, or maybe you're concerned about the fact that all the money in your IRA hasn't been taxed, and if you leave it to your kids, then they would have to deal with that, then life insurance, or the life insurance that they would ultimately inherit, it could be used to pay the tax because life insurance is not taxable as income. So these are some of the strategies that you might want to contemplate. And I encourage you to do so. Just don't put your head in the sand. All right, so as I wrap up, if there's one takeaway that you get from this webinar, it should be this: that I think that taxes are very likely to rise, and now is the time to do something about it. You have to be proactive. Now, if your current plan does not have a tax reduction strategy, then you don't have a holistic financial plan. You maybe have an investment strategy, you maybe have an income plan, but the biggest threat, in my opinion, to your net worth, it's not the stock market. Stock markets tend to come back after they go down. It's taxes, because once you pay the tax, you've lost the money and you've lost the ability to invest that money. And that, my friends, is a real loss. So what can you do to avoid losing all of your money to taxes? Well, you can book a 15-minute phone call with me. If you visit talktomarcus.com, if you go there, you'll see my schedule. Just pick a 15-minute time that works for you. Either me or a member of my team will call you, and we'll first decide if you need our help. If you have any questions, we'll answer them. If you need our help, we'll possibly discuss scheduling a follow-up meeting. Also, if you know anybody that could benefit from this webinar, feel free to share it with them. I want to thank all of you all for attending. If you have any questions, like I said, just go to talktomarcus.com. Until next time.